Good day, students. I will be doing this question 1 that will be based on the general journal, the ledger accounts, and accounting equation. We are given the entries on the month of January, and it says on the 3rd of January, a medical practitioner, a medic man, invests cash of 20,000 and equipment of 30,000 in medical practice. So now this is the money that has been contributed by the owner of the business in this medical practice, and 20,000 of cash was deposited, and also equipment to the value of 30,000 was invested in this practice. And they gave us all the other entries as we go forward. I will read them as I answer the requirements. And now I just want to go to what we are required to do. We are required to record the above transactions in the general journal, and then after record them in the ledger accounts. And the second requirement is to record all the above into the accounting equation. So now I will start with the first one where I do the general journal. Then after I will go to the general ledger. Then after I will do the accounting equation. So now as we have seen that the owner has deposited cash, as I said in the beginning, cash of 20,000 rands. That means our bank will be increasing because we receive money, or the business would have received money, and we know that bank increase on the debit side. So now that will mean bank will be recorded on the debit side. And also equipment is an asset, and we know that, let me also say that bank is an asset, and we also know that equipment is an asset. And equipment of the business, in this case, they will be increasing. It will be a plus on the equipment because the business has received equipment to the value of 30,000. And now, because these two contributions were made by the owner to the business, therefore now that means capital contribution will also increase. Capital will increase by the total of 20,000 plus 30,000, which means the sum of 50,000 that has been contributed by the owner. So now when we record this in the general journal, we first have to start with the debit entries. And the debit entries will be the bank, because we received money, and this was on the 3rd of the month of January. This will be bank, and our bank will be increasing by the amount of 20,000 because we received money into the bank account that was deposited by the owner. And the business also received equipment from the owner, and that equipment will be increasing the assets of the business, and we know that assets increase on the debit side. So that is why the equipment, we record it on the debit side. And at the same time, the capital that has been contributed by the owner will also increase, because the capital contributed, the total that will value up to 50,000 rands. So now on the credit side, the total of the capital will be 50,000 rands. And this capital is made of the value of money 20,000 deposited by the owner, and the equipment deposited by the owner to the value of 30,000 rands. So now this will be our general entry for the capital that has been contributed by the owner in the form of equipment and in the form of cash in the bank of 20,000. So now we can see that our total of the debit side, take this into account, our total of the debit side is 50,000 rands, and our total of the credit side is 50,000 rands. So that means the debit side is again equal to the credit side, and it must always be that after an entry has been completely recorded. Then we go to the second adjustment, which is on the 4th day of the month of January. On the 4th day of the month of January, it says that he treats a patient and receives his fee of 3,000. Remember, this business is about the medical practice. So now that means the owner receives money through the treatment of the patients. So whenever I treat the patient will give him money, and that is his source of income because he's a medical practitioner. So now he treated a patient, and after treated the patient gave him an amount or a fee of 3,000. So now that means obviously the bank account will be affected because money was received. So bank will increase. Why bank will increase? Because we receive money from this customer. And secondly, our income will also increase. Income will also increase because the owner has received money in the form of income from treating of the patient. So now we know that the bank will be increasing on the debit side and income will be increasing on the credit side. So now when we do our general entry, we will say on the 4th day, and we debit our bank money that was received from the patient, and the amount that we received from the patient was an amount of 3,000 rands, and we increase our bank by the amount that we received. Then after we say income or service income, because this business is rendering a service income, and this income amounted to 3,000 rands. Now remember, income increases on the credit side. So now whenever we receive or whenever we earn income, we record that income on the credit side. So now in this case, our income is increasing on the credit side, and also our bank account is increasing on the debit side. And our debit side is, as usual, the same as our credit side. Now we go to transaction number 6, and transaction number 6 says he bought new equipment. And remember, equipment is an asset. He bought new equipment, that means he bought new assets. And we know that equipment will increase on the debit side. So now, and he bought this new equipment from a supplier, but he bought this equipment on credit. It says on credit from AB suppliers for 6,000. And whenever you buy something on credit, liabilities will be affected. And those liabilities are called account payables. Those liabilities are called account payables. So now that means account payables will increase. Account payables will increase because it's liabilities, since we bought this new equipment on credit. Therefore, the liabilities of the business will increase. And we know that account payables increase on the credit side. Therefore, now we record the amount of the equipment, which is the increase in our assets. And the date of this transaction is on the 6th of the month of January. So now we say, because we bought an equipment, therefore now an equipment must increase. And we know that equipment is an asset, and assets increase on the debit side. So now here is an asset increasing on the debit side. And because we bought this equipment on credit, therefore now our liabilities will increase on the credit side. So now our account payables, which is the liabilities, meaning the people that we owe money, will increase by an amount of 6,000, because this 6,000 has not yet been paid. We bought an equipment on credit to the value of 6,000 rands. So now that will be the second journal entry that we have, third journal entry that we have already recorded. Then the next one says he treats patient. Again, now remember, the main business of this person, which is a medical practitioner, medic man, the main business is to treat patient because he is a medical practitioner. So now he treats a patient on account, that means on credit, in other words, on credit. That means he treats the patient on credit, and the value of the fee was 3,600. And remember, whenever he treats a patient, that will be income. So now it means the income for this owner will be increasing, and we know that income increased on the credit side. Then after we say he treated the customer on credit, that means our account receivables, meaning our debtors, will increase. Remember, a debtor is somebody who owes you money. And whenever you render a service or you sell a product to someone on credit, meaning the people who owe you money will be increasing. In this case, our account receivable, that means people who owe us money, are increasing by 3,000 because this patient has not yet paid this medical practitioner. So now it will be account receivables. Account receivables, that means money that will be received in the future. Account receivables will be increasing, and we know that account receivables increase on the debit side because account receivables is an asset. So now it means on the debit side we record account receivables increasing, and on the credit side we record income, and our income will also be increasing. So now we record that in our journal entry, that was number 7, and we debit our account receivables. We record our account receivables, and that will be an amount of 3,500 rands. Then after we say our service income, which is the income that we have earned for rendering the service to this client, then now it will be 3,500 service income. We have rendered a service to this client. So now this will be an amount of 3,000, and you can see that the debit side is equal to the credit side. And now we go to the next entry, and the next entry tells us that it says on the 10th day of the month of January, paid AB suppliers on account, which is 2,000. Remember, on the 6th day, we bought equipment from AB supplier on credit. That was equipment we bought on credit. So now when we make a payment, we are paying AB supplier for the equipment that we bought, which was valued at 6,000 rands, but we're only paying 2,000 rands. And whenever it says paid, that means the money went out. Therefore now bank will decrease because money is going out of the business. Bank will decrease, and we know that bank decreased on the credit side. So now it means we have to record our bank on the credit side. And because we are paying a supplier, or because we are paying our liabilities, therefore now our liabilities will have to decrease on the debit side because liabilities decreased on the debit side. And in this case, the liability that we are talking about is the liability that is called account payables. That means people that we owe them money. So now account payables will decrease, and account payables decrease on the debit side because account payables are liabilities. So now that means our liabilities will decrease on the debit side, while our bank will also be decreasing on the credit side because the bank is an asset. So now because money went out, then our bank will decrease and account payables will be also decreasing. That was on the 10th day. Remember, when it comes to general journal, we have to start with the debit, then after record the credit. Then we have account payables, and our account payables are decreasing on the debit side by the amount that was paid. Then after, our bank account will have to decrease, and we know that the bank is an asset, and assets decrease on the credit side. And in this case, our bank is decreasing because money went out of the business to pay the creditor or to pay the account payables. Then after, we go to the next entry, and the next entry is on the 12th day of the month of January. On the 12th of the month of January, it says patient paid their account 1,300. Remember, there was a patient on the 7th day that was treated on credit or on account, and that amounted to 3.5. The customer did not pay us, and now the customer is paying us. Say patient paid their account 1,300. It means we received money from the patient, and if we received money from the patient, it means our bank will increase and we know that bank increased on the debit side. And now if we received money, it means the account of the customer must be decreasing. So now that means our account receivables will have to be decreasing. Our account receivables will have to decrease, and account receivables decrease on the credit side. Let me just show you under number 7. Under number 7, when the customer bought on credit, take note of that. When the customer bought on credit, we increased the account receivables, and account receivables increased on the debit side by 3,500. So now when the customer is making the payment, we need to reduce this. And to decrease this amount, we have to record the amount the customer has paid on the credit side. So now that is why we have to reduce our account receivables by the amount the customer has paid on the credit side, because we are reducing that account receivable which was increased on the debit side when the customer bought, or when the customer was treated on account. Then after we have to then receive this as money in the bank, then after reduce the account of the customer, because the customer has paid us. So now he expects that his account will decrease by the amount that he has paid us. So now that will be debit to our bank account, and that is on the 12th. That will be debit in our bank account. Then you say on the 12th we debit our bank because we received money. Because we received money from the customer, we say bank, and that is 1,300. Then after we credit our account receivables, we credit our account receivables, and that will be 1,300. Remember, I did link the two, that we are reducing the amount of 3.5, and for us to reduce that, we have to record it on the credit side. That is why the description is the same, account receivables, and here it was account receivables. But here the customer was owing us money, and here the customer is paying us money. So now the account of the customer, which is account receivables, has to decrease on the credit side, because account receivables an asset, and assets decrease on the credit side. And in this case, the customer has paid us, so now we must reduce his account on the credit side by the amount that the customer has paid. Then now we go to the next one, and the next entry is on the 25th of the month. And on the 25th of the month, it says paid salaries on the receptionist 1,800. So now remember, salary is an expense, and expense increase on the debit side. So now whenever you pay an expense, expense will be increasing on the debit side. So now in this case, we have paid an expense, and expenses are increasing. That means there is more money that we are paying to salaries, which is our staff. Therefore now our bank will have to decrease, because money is going out. We are paying money to our employees. Bank will decrease, and we know that bank decreased on the credit side. So now it will be decreasing our bank on the credit side and increasing our expense on the debit side, because we are paying for this expense. And this is on the 25th of the month of January. Then after we debit our salaries, and we say salaries, and that will be an amount of 1,800. Then after we credit our bank, because money is going out to pay salaries. Therefore now this will be 1,800. 1,800 will be the amount of cash that will go out because of salaries that were paid to our employees. And now this is the entry which is 2 before the last entries. Then we are now on the 30th of the month of January. And it says on the 30th of the month of January, we received interest on the bank account, 50 rand. So now that means our bank account had a favorable balance. So that means we had a positive bank balance. Therefore, now we received an interest on that, and we know that this will be income. This will be income, and income that is called interest income. And our interest income, we know that interest is increasing on the credit side. Interest is income, and it is said interest income, it will increase on the credit side. And because we have received money, therefore now our bank account will also have to increase. Now our bank account will have to increase by the amount of the interest that we have received. Then our bank will increase, and we know that bank is an asset, and bank will increase on the debit side. So now let us record this entry of the interest that we have received. Then this is on the 30th of the month of January, and we debit our bank account because money was received in the form of interest, and that interest was 50 rand. Then after, because interest is income, therefore now we credit our interest income, and interest income is increasing on the credit side, and we know that incomes increased on the credit side. So now again our debit side is equal to our credit side. And this is the entry that is before the last journal entry before we do the ledger accounts. And the last one now is on the 30th or on the 31st of the month of January. And on the 31st of the month of January says drew cash for personal use 1,000. That means the owner withdraw money, which is 1,000 rand for his personal use. And we know that this is called drawings. And if the owner draw money for personal use, is drawings. And drawings will be increasing. Whenever the owner makes drawings, drawings are increasing. However, when the owner withdraw, whatever the owner withdraws will decrease. And in this case, the owner withdraw money. And now, because the owner withdraw money, therefore now money will have to decrease. And money is, we call it bank. And we know that bank will decrease on the credit side, and drawings increase on the debit side. So now in this case, whenever there are drawings, drawings will always be increasing on the debit side. But whatever that the owner is withdrawing will decrease, of which in this case, what the owner is drawing is money. Therefore now money, which is bank, will have to decrease. And we know that bank decreased on the credit side. So now that is why we record that as a negative on the credit side. Then now we record these drawings, and the owner that withdrawed an amount of 1,000 rand. Then it's debit and it's credit. And the date is on the 31st. And we said that drawings increase always on the debit side. Drawings increase always on the debit side. And our drawings will be an amount of 1,000 rand. Then after we credit our bank, or we credit whatever the owner took. And the owner took money. And because the owner took money from the business, therefore now money will have to decrease. And we know that money, which is bank, decreased on the credit side. And that is why now we have recorded bank on the credit side of the general journal. And this was the last entry to record. This was the last entry to record. Then now we are done with the general journal. And after we are done with the general journal, it will then mean that we have covered all that was required in the first requirement. And now we can go to the second part of requirement number 1. The second part of requirement number 1 is to compile or to do ledger accounts. Ledger accounts. So now we'll open ledger accounts for all the entries that need ledger accounts to be opened. Then after, we will do the so-called accounting equation. So now we have to do the ledger accounts, and I will just continue on the same page. I will continue on the same page, but just with a different color. Then now we are doing ledger accounts. We are doing ledger accounts. And under ledger accounts, we will open ledger accounts according to the transactions as we read them. We are doing ledger accounts and will open them according to the transactions as we read them. And the first ledger account that we'll have to open will be from the 3rd of January, where it says a medical practitioner, which is Medicman, invest cash of 20,000 and equipment of 30,000 in a medical practice. So now we see that there is money that is involved, 20,000 deposited in the bank account, and we see that there is another asset that is called equipment. Remember, both of these are assets. Bank is an asset, and we also know that equipment is an asset. And they both increase on the debit side. Both of them, they increase on the debit side. So now we have to open two ledger accounts here, and another one is the capital that has been contributed, which is capital contribution, because the owner contributed capital in the form of money 20,000 and in the form of equipment 30,000. That means the total of the capital that was contributed will definitely be 50,000 rands, which is divided into 20,000 bank and 30,000 equipment. So now we have to open the three ledger account at the same time. Then now the first ledger account will be bank, and we open our bank account. And our bank account, we know that bank is an asset, and bank increased on the debit side and it decreased on the credit side. So now we draw enough lines because there might be other entries that will affect our bank. Then after, we have another entry for equipment, and we also know that an equipment is an asset, and assets increase on the debit side and assets decrease on the credit side. And in this case, we bought more assets, therefore now our assets will have to increase. And the next one will be capital contribution. The next one will be capital contribution. It will be capital contribution, and we know that capital contribution is an equity item. It is an item that is recorded under equity, and capital increases on the credit side and capital decreases on the debit side. In this case, there was a capital that was increased by the owner. Therefore, now we expect that capital will have to increase. In this case, we received money in the bank, and that money was 20,000 rands. And that money was received because of capital that was contributed by the owner. Therefore, now it will be capital contribution. It will be capital contribution. And we said that equipment will have to increase because the business will have more equipments. Why will the business have more equipments? It's because there was a capital that was contributed by the owner in the form of equipment. Therefore, now the entry will be capital contribution. The entry will be capital contribution. Once again, because this was equipment contributed by the owner to the business. So now under capital contribution, remember the owner contributed two things. The owner contributed 20,000 in the form of bank. That means part of the capital will be bank. And the owner contributed 30,000 in the form of equipment. That means part of the capital will be equipment. That is why now when we do a ledger account for equipment, we have to record both forms of capital contribution, of which the first form of capital contribution was bank. The first form of capital contribution was bank, and the bank was 20,000 rands. And the second capital contribution was in the form of equipment, and that will be at the value of 30,000 rands. And if you see, this is the ledger account for capital contribution. So now if this is the capital contribution ledger account, you ask yourself, what did the owner contribute? He contributed money, which is bank. How much? 20,000. What else did the owner contribute? He contributed equipment for the value of 30,000 rands. That means our capital contribution is the total of bank and equipment, and the sum of that will be 50,000 rands. So now we have recorded the capital contribution entry, and if we have to take into account the date, that was on the 3rd of January. That will be on the 3rd of January if we write the date, and that will be on the 3rd of January. And that will be also on the 3rd of January. That will be on the 3rd of January if we have to take the date into account. So now that will be on the 3rd of January. There's legal space. Then after we have recorded the first entry, we have recorded the first entry where the owner contributed capital. Then now we have to go to the next entry and see what the next entry has for us. The next entry says he treats a patient and receives his fee of 3,000. So now he treated a patient, and I said if you treat a patient and receive money, that will be a service income, because this person is rendering the service, or this practitioner. So now our income will increase, and we know that income increased on the credit side. And we said because the owner received the money, therefore now bank will have to increase. That means the bank will have to increase on the debit side. And meaning in this case, we only need to open a ledger account for service income, because we already have a ledger account for bank. So now let us increase our bank by the amount that was received. Therefore now our bank will be increased by the amount that was received, which is 3,000 rands, just to confirm. Yes, 3,000 rands is the amount that was received from the patient. It will be 3,000. And the reason we received this money is because we rendered service, or this is the money from the service income. Services rendered in the form of treating a patient. Then after now we have to open a ledger account for service income. We have to open a ledger account for service income. And we do open our ledger account for service income. Then after, we know that incomes decrease on the debit side, and they increase on the credit side. In this case, our income is increasing by 3,000 rands, and that income increased because we received money. We received money. We treated the patient, and money was received after the patient was treated. So now we record that 3,000 on the credit side of the service income. And the date also being important was on the 4th of January in the month, or the 4th of January. Then after now we go to the next one, and the next entry is on the 6th of the month of January. The next entry is on the 6th of the month of January. It says on the 6th of January, he bought new equipment. So now we see that equipment is increasing. Equipment is increasing, and we know that equipment increase on the debit side. And he bought this equipment on account. That means on credit. He did not pay money for that. It says he bought equipment on account. That means on credit. Therefore now if it's on credit, it means account payables, liabilities will increase, because this person did not pay. Account payables will increase, and account payables increase on the credit side. So now we have already opened a ledger account for equipment. We only need to open a ledger account for account payables, where our liabilities, meaning the people that we owe money, have increased because we bought on credit, meaning we bought without paying to this supplier, which is AB Suppliers. So now because we bought equipment, therefore now equipment will have to increase. And I'll always say whatever you buy, it will always increase. Whatever you acquire will always increase. Then in this case, we have to record under our equipment the value of the new equipment that was bought. And the value of the new equipment that was bought it is 6,000 rands. So now we record this 6,000 rands on the debit side because our equipments are increasing by 6,000. But because we did not pay, therefore now the double entry will be account payables. That means our liabilities are increasing because we bought this equipment. Our liabilities are increasing because we bought a new equipment on credit. Then now we have to open a ledger account for our account payables. That means where we record all the entries that relate to our liabilities. Whenever we buy on credit from AB supplier, this is the account where we keep the record. And whenever we pay our suppliers, this is where we keep the record of the suppliers. And we know that suppliers decrease on the debit side because this is the liability. And liabilities increase on the credit side. So now in this case, our liabilities are increasing because we bought equipment and we did not pay for that equipment. Therefore now we say the reason our account payables are increasing is the one that we write here. The reason why our account payables are increasing is because we bought equipment. It's because we bought equipment, and that will be what we call the double entry, which is equipment of 6,000 rands. Then after we say we have completed this entry, and we go to the next entry. And the next entry tells us that it's on the 7th of the month of January. And it says he treats a patient once again, but now it says on account. That means on credit. On account means credit. Meaning after he treated the patient did not pay the money immediately. And that amount was 3,600. And whenever a customer does not pay money, that is called account receivables. That means money that will still be received in the future. Account receivables. And that means account receivables will increase, and they increase on the debit side. And why account receivables will increase is because people who owe us money, they are increasing. If this patient was not treated, he was not going to owe us money. But this medical practitioner treated the patient, but the patient did not pay. Therefore, now the account of the customer, which is account receivables, will have to increase. And we know that account receivable is an asset account, and assets increase on the debit side. And now because the business is in the or this practitioner is in the business of treating patient, so now his main source of income is rendering the service. So now that means the service income or the income of this medical practitioner will increase on the credit side. Although he did not receive the money, but we have the right to recognize this as income because it is accrued, because of the accrual accounting principle that allows us to recognize incomes when we earn them. And in this case, we know that we're supposed to receive this money. Therefore, now we must record this as income now, as opposed when the customer is paying us. So now we already have opened an account for service income, but now we only need to open an account for account receivable, increasing that on the debit side. So now let us start increase our service income by the amount of 3,500 that we treated the customer for that he did not pay us. Then I will say our income will increase. And our income is increasing because we treated a customer and that customer did not pay us. And therefore now it is because of the account receivables. It is because of the account receivables. The money was not received. Therefore now the double entry will be account receivables. Then after we open a ledger account for account receivables. We open a ledger account for account receivables. Our account receivables, meaning our customers who owe us money, they are increasing. And we know that account receivables is an asset. And if account receivable is an asset, it is increasing on the debit side. and decrease on the credit side. Then after, now we draw a line in between as usual in the ledger account, and our account receivables are increasing by 3,500. And why are the account receivables increases? Because we rendered in service to the customer and the customer did not pay us. Therefore, now that will be service income. Remember the double entry accounting principle that I've taught you. It says for every credit entry, or for every credit entry, there should be, or there must be, a debit entry. And in this case, under our account receivables, we debited service income. That means under service income, we credit account receivables. That's why it says for every debit entry, there must be a credit entry. So now we can see that our double entry principle is still applicable even in this case, and we are applying it very good. Then now we have recorded this entry where the customer was treated on account. Then now we go to the next one, and the next one is on the 10th day of the month, where we paid AB suppliers on account. Remember, previously we bought on the 6th day of the month of January. On the 6th, we bought a new equipment on credit from AB supplier for how much? For 6,000. And therefore now, when we make a payment, we are reducing our suppliers, because our suppliers, we have paid them 2,000 out of the 6,000. And if we pay 2,000 out of the 6,000, therefore our suppliers must decrease. And our bank will also decrease by the same amount. Meaning now our account payables, will decrease on the credit side. And at the same time, our bank will decrease on the, our account payables, that is a mistake. Our account payables will decrease on the debit side, because these are the liabilities. Liabilities decrease on the debit side. Then after, our bank will decrease on the credit side, because bank is an asset, and assets decrease on the credit side. And in this case, money went out. Therefore now our bank will decrease on the credit side. And because we have paid our creditors, or we have paid our liabilities, therefore now they must decrease, and liabilities decrease on the debit side by the amount that we have paid. So now I think we already have a ledger account for account payables and also a ledger account for bank. Then now we start with the account payable ledger account that we already have in our forefront. So now we say our account payables, remember, they decrease on the debit side, because account payables is a liability. Therefore now we record the amount of 2,000 on the debit side, where we are reducing our account payables. And our account payables are decreasing because we paid them. So now that means the double entry will be bank. That means our bank account now will have to decrease by 2,000. And the reason why, remember, bank account is an asset, it decreases on the credit side. So now that means our bank will decrease by an amount of 2,000. And why is the bank decreasing? Is because we paid account payables. We paid one of the suppliers, so we paid our suppliers, which is AB suppliers. That will be the description. That means the double entry, which is the reason why bank decreases, because account payables were paid. Then after, we go to the next entry and we see what the next entry has for us. And the next entry says that the next entry is on the 12th of the month. And on the 12th of the month, it says that patient paid their account. Remember, on the 7th, we treated, it says he treats a patient on account. This customer did not pay here. Remember, this customer did not pay, and this customer is paying now. In other words, customer did not pay here, and the customer is paying now. So now the customer is paying the amount that he was owing, which was 3.5, but he only pays 1.3. So now remember, when the customer was treated and he did not pay, the account receivables was recorded as increase. But now because the customer has paid us, therefore now the account receivable, that means the money that our customers are owing us is decreasing, and account receivables will decrease on the credit side because account receivable is an asset, and whenever the customer pays, then the account receivable, which is the account of the customer, must decrease on the credit side. And when the customer was paying us, obviously we would have received money. Then now if we receive money, it means our bank, which is an asset, will increase because we are receiving this money from the customer, and it will be increasing our bank account on the debit side. So now let us go and decrease our account receivables by the same amount of 1.3 and increase our bank account by the same amount of 1.3 that was received from the customer who was previously treated on account. And now we go to our automatically bank account, and our bank account will increase by 1,300. And why is that? Is because the customer has paid. Therefore now that means account receivables is the reason why we're receiving money. Account receivables, meaning the customer has paid us, and that customer is under the so-called account receivable because it's money that he owed us previously. Then after we say now under our account receivable, we need to reduce our account receivables. Remember, when the customer was treated on account, and that was number 7, if I'm still correct. Yes, when the customer was treated here, we increased the account of the customer by the amount he owed us because he did not pay us the 3.5, or he did not pay this medical practitioner 3.5, meaning now the account of the customer was increased by 3.5 because the customer was owing this medical practitioner 3.5. But when the customer is paying, we expect that his account must decrease on the credit side. That is why we record 1,300, and that will be in the form of bank. The reason why the account receivable is decreasing because the customer paid us for cash, and that was bank. So now we have recorded both of the entries under our account receivables and under our bank account. Then now we say in the next entry, the next entry tells us that it's on the 25th of the month of January. Paid the salaries or the salary of the reception 1,800. So now this is a payment. Whenever we pay, bank will decrease. Bank will decrease, and bank decreases on the credit side. And in this case, we have a salary of the reception. A salary will be increasing because this is an expense. Expenses increase on the debit side. So now we have paid a salary, therefore now it will be increasing on the debit side. That means if there was no receptionist, this salary would not have been increased. That means salary would have remained at 0. But because we are paying this, therefore now salaries that are being paid to a reception are increasing by the amount of 1,800. Let us first record the credit side where money is going out, reducing our bank account. Therefore now our bank will decrease by 1,800. Why? Is because of the salary that was paid. Our bank is decreasing because a salary was paid out to a receptionist of this medical practitioner. Therefore now we have to open a ledger account for salary because we did not open that ledger account for salary. Then after we know that salary is an expense, don't forget that salary is an expense, and expenses increase on the debit side. Whenever you pay them or whenever you incur, they increase on the debit side, and salaries decrease on the credit side. In this case, as I mentioned to you before, that if there was no salary, this account would have remained zero forever. But now we are making a payment. It means our salaries the salaries that are being paid to the employees have increased, and our salaries are increasing because a payment was made to the secretary. Therefore, now we have recorded our salaries increasing by 1.8, and now because money was paid to this secretary, we have already recognized that money is going out, and it is 1,800 rands. And we have recorded it on the both sides, debit side of the salary and the credit side of the bank account. Then after we go to the next entry, and the next entry is on the 30th of the month of January. It is on the 30th of the month of January, and it says that we received interest on the bank account, and that interest is 50 rand. And if we receive something, in this case being interest, it will be interest income. This will be interest income. Therefore, now this will be another account, and we know that interest income will be increasing on the credit side because incomes increase on the credit side. Then after we say, because we received money, therefore now our bank account will have to increase, and our bank account will increase on the debit side. So now we only need to open a ledger account for the interest income because we already have the account for bank. Now, because money was received, it means our bank will increase, and our bank will increase by the amount that was received, and that amount that was received was interest income. It was interest income, or interest on the debit balance of bank. Then after I said that we have to open another new ledger account for interest. Therefore, now we have to open this ledger account for interest income. And interest income, it is income as it says interest income. Therefore, now if this is income, we should know by now that incomes increase on the credit side and they decrease on the debit side. And in this case, our incomes have increased by 50 rand, and is increased because money was received, and that money was in the form of income. So now the double entry, guys, if you can say, for every credit entry, meaning if bank is credited under interest income, it means interest income must be debited under bank account. Please take note of that, guys. It's very important. So now we have also applied the double entry rule when it also comes to this one. Then now we check for the next entry, which is the last entry, where the owner withdraw some money out of the business for personal use, and we know that is called drawings already. On the 31st of the month of January, it says drew cash for personal use, and that will be 1,000 rand. And we know that whenever the owner draws something from the business for personal use, that is called drawings. Therefore, now drawings will increase by the amount of 1,000 rand, and we know that drawings increased on the debit side. And now because the owner took money from the business, it means the bank account of the business will have to decrease by the same amount the owner withdraw, and we know that bank is an asset and bank decreases on the credit side because the owner took money out of the business. So now we have to open one account, which is an account for drawings, because we have not yet opened a ledger account for drawings, but with the bank we already have the ledger account for bank. So now let us start with the ledger account for drawings, and we open a ledger account for drawings. And as I always do so, I will indicate which side drawings increase and which side they decrease. Drawings increase on the debit side and they decrease on the credit side. And whenever the owner withdraw anything, drawings will always be increasing on the debit side. And the reason why in this case drawings are increasing is because the owner took money out of the business. Therefore, now we have to go to the bank account and recognize the same entry and say our bank is decreasing by the value of 1,000 rand, or an amount of 1,000 rand. And the reason why our bank is doing that, it is because there was money that was drawn by the owner, that is drawings. So now we have captured all that was needed to be captured with regard to all these general entries up to the 31st of January. Then now from here we can balance all the ledger accounts, and after we have balanced the ledger accounts, I will do the last part, which is to do the accounting equation. Then after now we start from the beginning and we balance assets and we close off all the entries. Then now we have to draw the two lines here. Although I have quite a limited space, I thought I brought enough space. Then now I have to calculate the total of the bigger side. The total of the bigger side. And in this case, let me start with the debit side of bank. 20,000 plus 3,000 plus 1,300 plus 50 rand, and this will give us 24,350. It will give us 24,350. And remember, I first have to compare the debit side and the credit side. And obviously, when I look at my credit side is smaller than my debit side. So now that is why I automatically take the amount of the debit side and I write it at the bottom. Therefore, now the difference will be a balance, and that will be a balance carried down. That will be a balance carried down, and the balance carried down will be on the 31st of January. And balance carried down will be the total of the debit side minus all the credit side, minus 2,000, minus 1,800, minus 1,000 rand. And it will be 19,550 rands. 19,550 rands. Then after now we'll have to have a balance brought down. Sorry for the limited space, but I'll just use a different color so that we can see. Our balance brought down, it will be the same amount of 19,550 rands. So now take note of the fact that balance brought down will be on the 1st of February, because balance brought down is a balance at the beginning of the period. Then our bank account will be balanced. Then now we go to the equipment, and equipment, we take this bigger side, and there's only one bigger side, debit side, because on the credit side we have nothing. So now we say 30,000 plus 6,000 will give us 36,000 rands, and this will be 36,000 rands. That means our balance will just be balance carried down on the 31st of January, and that will be 36,000 rands, and it will be 36,000 rands again. This will be balance brought down. Brought down is on the 1st of February, beginning of the next month. Balance brought down. Then after we will have the capital that was contributed. We will have the capital that was contributed, and the capital that was contributed amounted to 50,000 rands, and the capital will be 50,000 rands. And we can just leave the capital there as it is. I only want to close the assets and the liabilities and ignore all others so far. Then now we have the service income, and our service income will be the total of the two amounts, and that will be 3,000 plus 3,500 That will give us an amount of 6,500. That will give us an amount of 6,500. Then we can just totalize that expense. Then we come to account payables. Remember, account payables is a liability. So now when you come to assets and liabilities, you must always balance them. There must be a balance brought down and a balance carried down. And the bigger side is 6,000 rands. And the bigger side is 6,000 rands, which is the credit side. Therefore now the balance brought down, the balance carried down is the difference between credit side and the debit side. So balance carried down, which is on the 31st of January, it will be the difference between the 6,000, which is the bigger side, minus the 2,000, which is the smaller side. 6,000, which is the bigger side, minus 2,000, which is the smaller side. That will give us 4,000. That means our account payables, or that means we owed 4,000 by the end of the month, because we paid an amount of 2,000. So obviously it has to be 4,000. In the beginning we owed 6,000 and we paid 2,000. So the balance that we owe by the end of the month to our account payables will be 4,000 rands. So now that balance will have to be brought down here as 4,000 rands, and it will be balance brought down, or balance brought forward on the 1st of February, beginning of the next month. Then now we go to assets. Remember, once again, when it comes to assets and liabilities, we have to balance our assets and liabilities. We have to balance our assets and liabilities. And we take the amount of the bigger side. And the amount of the big side is 3.5, or the bigger amount is on the debit side 3,500. Therefore now the balance carried down is always on the smaller side. The balance carried down is always on the smaller side. The balance carried down is always on the smaller side. And our balance carried down is the difference between 3,500 minus 1,300, and that will give us 2,200 rands. Therefore now that will be the balance carried down, and we have to bring that balance in the beginning of the next month. That is why we have balance brought down of 2,200, because beginning of next month we want to see the same balance of the customers that owe us. Therefore now this will be the balance brought down. This will be the balance BD, and it's on the 1st of February, beginning of next month. This is on the 31st of January. Therefore now we have closed, or we have balanced this. Then after we come to the expense account, it is 1,800. Please do not balance expenses. Do not balance expenses. Just write their total so far. Then after we come to the interest, and we know that interest, it is income, and we just have to write the total of the interest as income. Then we write the total of the interest as income, which is 50 rand. And also with regard to drawings, we write that 1,000 rand as it is. It's only income, it's only assets and liabilities that I want you to balance, but don't balance your equity section. Then after we have 1,000 rand of our drawings. So now we have balanced all the ledger account as it will be. And the next stage, which is also a very critical stage, is the so-called accounting equation. It is the so-called accounting equation. So now we are doing accounting equation. This is the very important equation to take into account. Accounting equation, and this accounting equation is at the 31st of January. And we have to have the columns, which is the date. Then after we have our assets, and our assets will be equal to our liabilities plus equity, owner's equity, and we have to write the column for the details for owner's equity. Then after, I have to draw the lines in between, very important, where we separate assets from liabilities and the owner's equity. So now we start with the first transaction, and the first transaction would have been on the 3rd of the month of January. And we go and we read all the general entries once again, and this is the last part that is also very important, more especially when it comes to the owner's equity. Take note of that. I will give you more clarity when it comes to the owner's equity as I do the entries. So now we are on the second requirement, which is to record all the above transactions in the accounting equation. Then now when we do this, we start with the first one, and the first entry said that on the 3rd of the month of January, a medical practitioner, which is Medicman, invest a cash of 20,000 rands into the business and equipment to the value of 30,000 rands into the business. And now this is the capital that has been contributed, and as I said to you that the total of the capital contributed by this owner, it is 50,000 rands. That is the total of the capital that he has contributed, meaning the capital contribution is 50,000 rands. That will affect the owner's equity, because capital contribution is owner's equity element and it increases the owner's equity. So now money was deposited into the cash or the bank of the business, and equipment was also contributed. And we know that money is an asset, and we know that equipment is an asset. And in this case, money is increasing, and we know in this case also equipment is increasing. So now both of the assets are increasing, which is 20,000 and 30,000 under our assets. So now we'll have to say plus 20,000, and this 20,000 is for bank. Remember, bank is an asset, and we also say plus 30,000, and this 30,000, it is for equipment. Then after we say under liability there is nothing, and under owner's equity we record the total of 50,000. Let me just record it on the first line. We record the total of 50,000, and this will be plus 50,000. Therefore, now under details, we have to write the reason. It is capital contribution. So now, if you see that our total assets is equal to 50,000, and our total liability is 0, our total equity is 50,000. Therefore, now our assets is equal to surely the owner's equity added with the liabilities. So now this is the first entry that we have recorded with regard to the capital. Remember guys, capital increase owner's equity, income increase owner's equity, drawings and expense reduce owner's equity. So now we go to the next date of this accounting equation. The next date says he treats patients and receive his fee of 3,000 rands. So now he treated a patient and received money. That means if he received money, this is bank, and bank is increasing. And we said this is income because his main income is to treat patient. Service income will also increase. Service income will also increase. Service income will increase, and we know that service income will increase our equity because it is positive under equity. So now let us increase our bank account because money was received. And the date of this entry is on the 4th. Money was received from the customer or from the client. On the 4th, we receive money, and this amount is an amount of 3,000 rands. Just to confirm, it is an amount of 3,000 rands. And we receive this money, therefore bank will increase, and bank is an asset. And there's nothing under owner's equity there's nothing under liabilities, but under owner's equity it will be 3,000 rands plus. Remember, income increase equity. Income increase equity. So now in this case, we have to say service income. Whenever an entry affects the owner's equity, you must write something under the details. Therefore, now we have owner's equity, and under details, we write that as service income. And the next entry is the entry that is on the 6th day of the month of January. That says he bought new equipment on credit from AP suppliers for 6,000 rands. So now he bought new equipment, and you know that equipment is an asset, and assets will be increasing. And because he bought on credit, and therefore now this is liabilities. That means liabilities will be increasing. Remember, this is the liability that is called account payables. This is the liability called account payables. So now if this is the liability called account payables, it means account payables, which is liabilities, will be increasing at the same time. Our assets are increasing because we bought an asset on credit. There's more equipment. At the same time, our liabilities will be increasing by the same amount of 6,000. So now I think the date was on the 7th, or it was on the 6th of the month of January. On the 6th of January, we say we have more equipments. Therefore, now our assets must increase by the value of the equipment that we acquired on credit. And at the same time, liabilities will increase by 6,000 because we did not pay for this equipment. Therefore, now it will be 6,000 increasing the liabilities of this medical practitioner. Then now we write nothing under owner's equity or under details whenever there is nothing that affects the owner's equity. Then now the next date is the 7th of the month of January, where it says he treats patient on account for 3,600. So now he treated a patient on account. And the minute he treats a patient, we know that to treat a patient, it is income. To treat a patient, it is service income. That is his main income. Whenever I treat a patient, he charges the patient. Therefore, now the incomes of this medical practitioner will increase. At the same time, the assets, because the customer did not pay. So now when the customer did not pay, then that we call account receivable. If the customer gets the service and doesn't pay for the service, then that is called account receivables. And account receivables is an asset. Therefore, now the assets of the business, meaning the people who owe this medical practitioner, will increase by the amount of 3.5. At the same time, his income will increase by the amount of 3.5, which is on the 7th of the month of January. Therefore, it means on the 7th, the assets will increase, and this assets will increase by 3.5 is account receivables. At the same time, we said that the income will be increasing by the same amount of 3,500 because to treat a patient is the main income of this medical practitioner. So now this will be a service income. And we know that income increases equity. Don't forget that. Income increases equity. So now that is why this is a plus under owner's equity. This is a plus under owner's equity. Now the next date is the 12th or is the 10th of the month of January. And on the 10th of January, we realizing that there was a payment to AB supplier, paid AB supplier on account. Remember, previously we bought equipment to the value of 6,000 on credit from AB supplier. So now we are making the payment. And we know that AP supplier is a liability to us because this is someone that we bought something on credit from. Therefore, now our bank will decrease because money is going out. And at the same time, we know that bank is an asset. That means assets will decrease. And we know that account payables, that means AP supplier is a liability. AP supplier is a liability. And liabilities will be decreasing in this case. And those liabilities that are decreasing is the liability that we call account. Remember, this is account payables. That means the account payables, meaning the liabilities of the business, will decrease whenever the business pay. At the same time, the bank of the business will decrease because money is going out. Therefore, now bank is an asset. That is on the 10th. That means minus to our assets by 2,000. Our bank will decrease. And liabilities will also decrease by 2,000 because we made a payment of 2,000 rands. So now we have recorded all that needs to be recorded. Then now we go to the next date, which is the 12th. The next date, which is the 12th. The next date, which is the 12th of the month of January. It says patients paid their account 1,300 rands. So now the patient paid, that means the patient paid us, or the patient paid the medical practitioner. And if the patient has paid that, it means the bank of the medical practitioner's business will increase. And we know that bank is an asset. Don't forget that. And assets will be increasing. And in this case, because this is the customer who previously was treated on account, this was from number 4. Sorry, it was number 7. This is the customer who previously was treated on credit. So now he pays 1.3. And when the customer was treated on credit, this increased the assets of the business. If you remember, by 3.5. When the customer was treated on credit, the assets of the business increased by 3.5 because the customer did not pay at that point in time. So when the customer pays, therefore now the assets of the business will have to decrease. That is why we have to say minus 3.5. So now that will be on the 12th minus 3,500. What is this 3.5 mean? This 3.5 is, it's not 3.5, it's 1.3. We are saying 1.3. This 1.3 is reducing the 3.5 because previously the customer was owing the medical practitioner 3.5. So now we are reducing that 3.5 by 1.3. And if you go back to the ledger account, I just want to show you something. In the ledger account, remember, when the customer was treated, we increased this account receivables. Here's the account receivables. We increase this account, and this account, you know that it increases on the debit side. We increased this by 3.5. And when the customer paid, we decreased this account by 1.3 on the credit side. But now we are not doing the ledger account, but the same effect should apply. So now it means the account receivables must be reduced by 1.3. And in this case, account receivable is an asset. So now it means our assets must decrease by the 1.3 that you see here, indicating that we are reducing this 3.5, which was previously an asset. At the same time, because we received money, and if we received money, therefore now our bank account must increase by 1,300 because we received money. And if you see this in the ledger account, once again, in the ledger account for bank, we received money. Here is the bank account is increasing on which side? On the debit side, bank. And bank is an asset. Therefore now, when bank is increasing on the debit side, that means our assets are increasing. So now, this is exactly the same thing as we did with the ledger account. I can reference to all of them, but it will take time for me to do that. So now all others will not be affected. All others will not be affected, and all others will not be affected. Then after now, we continue on that same note and we do the next transaction. And the next transaction is on the date, which is the 25. Only 3 entries are left. Then after I am done. On the 25, it says paid the salary of the reception, 1.8. We know that if we pay it, bank will decrease. Bank will decrease because money is going out. And we know that bank is an asset. Then after we say salary. Now in this case, take note that salary reduce equity. Salary reduce equity. Or in simple terms, salary is an expense and expenses reduces equity. Salary is an expense and expenses reduce equity. Expense decrease equity. So now when we record the salary under owner's equity, we will record the salary as the negative amount because salary is an expense and expenses reduces equity. So now we have to reduce our bank because money is going out. And we say on the 25th, money went out. Money went out and that amount was 1.8, therefore it reduced our assets. And we say our owner's equity will decrease by 1.8. Why? Because expenses reduce equity. We don't look at the fact that salaries are increasing. Yes, salaries are increasing, but our salaries, they reduce the owner's equity. Therefore, now under description, we say salary. Please don't forget that we look at the effect of salaries to owner's equity. And the reason why incomes here was the plus because incomes increase equity. And the reason why 50,000 was positive because capital increases equity. So now that is why for those it becomes simple, but expense and drawings reduce the owner's equity. So all the time you must know that owner's equity is reduced by drawings and expenses. And now on the 30th of the month of January, one transaction before the last. On the 30th of the month, it says received interest on the bank account, and that is 50 rand. When we receive money, that means the bank will increase. And because this is income, therefore now service income will also increase. Remember, income increase equity. Don't forget that. Income increase equity. But expense decrease equity. So now meaning our bank will increase by 50 rand. And that is on the 30th of the month. And because this is income and we know that income increase equity, therefore now it will be plus under equity. Then after this will be interest income. This will be interest income. This will be interest income. Then after now we go to the last and the last entry before I write all my totals. The last entry is the drawings. I suppose you know by now that drew cash for personal use 1,000 rand. The owner withdraw money. Therefore now drawings will increase. But take note of that. Drawings decrease equity. Drawings decrease equity. So now although drawings are increasing, and in the ledger account, take note of that, in the ledger account of drawings, we recognized drawings increasing, and here is drawings, they increase on the debit side, and here they are recorded on the debit side. But don't forget that drawings decrease equity. So now when we do accounting equation, we record from the perspective of the effect of drawings under the owner's equity. So now drawings decrease equity, or drawings decrease owner's equity, meaning the amount of drawings must be recorded as negative under owner's equity, 1,000 rand. And under description, it will be drawings. Then after, now we say the owner took money, therefore now our assets will decrease because money is an asset. And that was on the 31st of the month of January. And this will be the last entry that I would have covered. Then now I can just write the totals for me here at the bottom. And the totals is very important to write them so that we check if there are any balances. And for this, it will give us 4,000 rands. And if you look at the liabilities, there was only one liability, account payables. And our account payables amounted to 4,000 balance at the end of the period. Our account payables had a balance of 4,000 at the end of the period. There was the balance. Account payables, remember this is the liability. Then, and this is the balance, which is 4,000. And we see now the same balance appear at the bottom as 4,000 rands. Then after we have our assets, and I'll write the total of the assets, which will be 20,000 plus 30,000 plus 3,000 plus 6,000 plus 3,500 minus 2,000 minus 1,300 plus 1,300 minus 1.8 plus 50 rands minus 1,000. Let me confirm. 20,000 plus 30,000 plus 3,000 plus 6,000 plus 3.5 minus 2,000 minus 1.3 plus 1.3 minus 1.8 plus 50 rand minus 1,000 rand. Then this will give us 57,750 rands. Then now our owner's equity will be a total of 50,000 plus 3,000 plus 3.5 minus 1.8 plus 50 rands minus 1,000 rand. And this gives us 53,750 rands. And if you say 53,750 plus 4,000, and this gives us the same 57,750, meaning that our assets are equal to the owner's equity plus liability. So now everything still balances when it comes to this. I just want to confirm this, just this figure, if things will work for me, where I just add all the balance of my assets and see if do they give me the same amount. I had my account receivables, and the balance of my account receivables was 2,200, and there was another asset, and this other asset will be bank, and bank balance was 19,550, and another asset would have been equipment plus 36,000. And you see, if I add the balance of all the assets, I get the same amount, because in the accounting equation we combined all the assets. If you see here, this is the total of all the assets that we have, 57,000 750. And if I take the ledger accounts and I take all the assets, and my assets, remember, account receivable is an asset. I take the balance of this asset, 2,200. Let me redo it for you. 2,200 plus another asset will be bank, and bank balance was here 19,550, and I say plus 19,550. And I take another asset would have been equipment, and the balance of equipment will be 36,000, and I add 36,000, and this gives me the same 57,750, which is the total assets that you see in the accounting equation at the bottom, meaning all the calculations so far are perfect and correct. With that, guys, thank you. God bless you.